As you see, all our panelists have extensive experience in China. They have weathered many market cycles and are no strangers to volatilities. Speaking of volatilities, I think it's a consensus that the post-pandemic global recovery has reached plateau. We witness unprecedented disruption to global supply chain and trade, and geopolitical tension continues to increase. We're also seeing regulatory framework set to tighten across all major economies. In China, we're seeing that the recent focus on sustainable growth as well as common prosperities. These measures are very popular with the average Chinese citizens, but on the other hand, it has also created some regulatory uncertainty and led to some unease among the global investment communities. On the other hand, China's economy continued to grow. Last year, it recorded the highest growth rate among the major economies, and China now accounts for 18% of the global GDP. China's consumption is about 12% of the global share. And China's capital market now is also a significant part of the global financial market, with the Asia market's market cap about 12.4% of the global market cap, and China's bond market about 14% of the value outstanding. So against this backdrop, I think it's easy to draw to the conclusion that China is a market that's too big to ignore for any investors. So today we would like to invite our panelists to share their insight how to allocate capital and position in China. Let me start with Qing. Qing, Chongyang Asset Management historically has been focused on value investing and absolute return. So with this stellar track record, can you share with us that what's your current assessment of the China's equity market, as well as your strategy to deliver risk-adjusted return for your investors? Thank you.
Oh, thank you for having me on this panel. I'm quite honored. Thank you, May, for moderating today's discussion. I still remember last time when I participated in Tcfa conference, that was 20 years ago in the year of 2000. When I used to work at IMF in Washington, D.C. So I'm very glad to attend the conference again, 20 years later. To your question, May, since Chongyang Investment is a China equity specialist, my discussion will be in the context of Chinese markets. Now it's the year end. Let me first give a very brief review of the market development so far this year. Chinese equity market had a wonderful run last year, actually. However, this year their performance is one of the worst globally. There are three salient factors I think have contributed to this rather poor performance. First and foremost, the Chinese authority implemented some really blunt and draconian regulatory measures targeting several industries, including education service and those platform tech companies and the healthcare sector. Those regulations not only dealt a severe shock, negative shock to those industries, but also greatly increased the risk premium of Chinese markets in general. Which implied, in the opening remark of May. The second factor is related to the overall economic policy environment. For those who watch Chinese market closely, you can tell that both the monetary and the fiscal policies have been very tight this year, such that both the economic cycle and the liquidity cycle have experienced sharp downturns. Especially since the second quarter this year. So this is the second factor. The third one is that the elevated commodity and energy prices, which are kind of a global phenomenon, but there's also this power shortage due to blackouts in the third quarter. All those developments created a problem that is a sizable wedge between PPI inflation and CPI inflation. Therefore, put really substantial cost pressures on the midstream and downstream industries. So those are the three factors which I believe could explain the really poor performance of Chinese market this year. But despite the poor performance of the market so far this year, looking ahead at this vintage point, we have actually turned a bit more constructive on the market outlook. And of course, at the same time, we think it's not yet time to become outright bullish, because there are three reasons. First, why not outright bullish at this moment? We expect the downturns of the economic cycle to continue through at least the next 3 to 6 months. While the current momentum on both consumption and investment remain quite weak, we have not yet detect any decisive shift in either fiscal or monetary policy posture. This is a deviation from the past practice. So we should stay vigilant, and we now pay quite close attention to China's export growth. If there were to be a sharp decline of Chinese export growth, it could be a trigger for policy change. And the second reason for being a little bit constructive is that the regulatory environment appears stabilizing at a new equilibrium. In other words, we believe the most severe phase of the shock to the targeted industry that we just mentioned about is largely over. So in this connection, I dismiss the idea that China has somehow become uninvestable, as argued by some China observers. As a veteran China equity investor, we have really seen this movie many times before. In the interest of time, I won't elaborate on this point. I'm sure many in the audience would agree with me. But I just want to say that it's unwise to turn structurally bearish on China simply based on this type of campaign-style policy making. And the third reason we should be a little bit constructive on the outlook of the market is that we expect the still wide spread between PPI and CPI inflation to narrow in the coming quarters, and this should help improve the earnings outlook for the midstream and the downstream sectors. And this change is triggered by the administrative measures implemented recently by Chinese authority to kind of debottleneck the power supply, also to crack down on commodity market speculations. I'm sure Hui Ming could comment on this point. So it's based on those three top-down observations we formulate our investment strategy going forward. When it comes to construction of the investment portfolio, I just want to highlight two types of opportunities. The first type is with the high quality large cap names, including tech companies listed in Hong Kong market and some top consumer and healthcare names in Asia market. First, they are really good companies, and more importantly, their valuation have come down to more reasonable levels after the market corrections. The second type of opportunity is with some small mid-cap stocks, mostly in manufacturing sector. And despite their recent weak performance, because we believe their long-term growth story remain unchanged, and their short-term cost pressure will likely ease in the near future, which a key reason being the potential narrowing of the spread of PPI and CPI inflation. So those are the points I would like to make in answer May's question. But before I finish, I would like to make a final point, which is a general observation of Chinese markets. And as many of you may be aware, a Chinese authority have carried out two important policy initiatives since 2018. and which have profound implications to equity market investment in China. And one policy change is to abolish the implicit guarantee clause that features many wealth management products offered by financial institutions, mainly commercial banks. And this policy change has managed to bring down the effective risk-free interest rates facing many retail investors, which obviously are going to have important implications. And the other policy change is the set of draconian anti-speculation measures in property markets, under the now well-known slogan that is "House is for living, not for investing." Those two policy changes have greatly limited investment opportunities for Chinese investors, making stock markets the primary choice of investing and wealth preservation. In other words, there's a secular shift in favor of equity market in terms of asset allocation by Chinese investors. This creates opportunities for both equity investment in general and equity-focused asset management business, in particular in China. I stop here. Thank you.